2025 and the trends we're following. That's today's Markets Magnified podcast. And for it, I'm joined by ETM Analytics Director and Head of Research, George Glynos. George, thank you for joining me on this. And of course, we all just came back from a great summer break and holiday, and I was with family. And you know what? Everywhere I went, no matter who I spoke to, no matter the age, Trump inadvertently always popped up in the conversation, whether it was a joke, whether it was the chaos that was 2024, whether it was, what's going to happen in 2025. The man just entered into every conversation, and he really is just this long orange shadow that's hanging over 2025.
Yeah, he's an interesting guy, polarizing guy, but he's going to turn the world upside down. He kind of has, and he's just a magnet for social media and media reactions. So, he's going to make the next few years as an analyst really interesting to comment on and to focus on. And I suspect that he's going to start with a bang. So he gets inaugurated next week, and from there on, I suspect that the fireworks are already going to start. So hold on to your hats. I think it's going to be a volatile beginning to his next term in office. But weirdly, I'm kind of looking forward to it. I haven't really enjoyed the general direction of things for a while now, economically speaking. Or politically speaking, for that matter, and so a bit of a shake-up is maybe in order, and let's see what that shake-up looks like. It's going to force people to concentrate and maybe change tack in some ways, and that's change of that nature is not necessarily always a bad thing.
He's made several policy promises, whether it's tax breaks. He's also made several threats with tariffs, grabbing Greenland, and everyone is concerned. It feels almost to me like everyone's either cozying up to Trump or hedging themselves for a worst case scenario. But likely he will, rather operate in the middle ground. I don't see him going as catastrophic as some people may want us to believe.
Yeah, so there's the reality of the American economy and geopolitics as they stand, and then there's the Trump rhetoric, and the Trump rhetoric is there purely to kind of spark a response of some sort. It's not necessarily reflective of exactly how things are going to play out. So, you and I have spoken about this before, but he's faced with several conundrums. And some of those conundrums are really interesting. For example, he wants to impose tariffs, and because he believes that tariffs are going to help him rebalance the trade account. But the reality is that the trade account is more affected by domestic monetary and economic policy than it is necessarily just tariffs. So the tariffs, I think, are there as a carrot and a stick to try and renegotiate and deliver on some of his promises. But I don't think that the ultimate impact of tariffs is going to be as big as people anticipate they're going to be, especially if they are more focused and more targeted. So, that's tariffs in a nutshell. Geopolitically, he wants to stop wars, but we know that the wars have stimulated his own war machine. And that's the military complex within the US, which has been part of the stimulus that's been applied to America, and which has obviously served them quite well. He wants to stop migration, except that a growing population is critical. It's fundamental to the growth of any economy. So you got to be a little bit careful in how you handle that, because if you go swing too hard the other way, and it comes at a point in time when unemployment's about to tick higher because your labor market loosens because you're at the end of a business cycle, all of a sudden that can compound very quickly. So, he's got some thinking to do along the migration things. They would argue that they're not going to stop legal migration. It's more the illegal mass entering into the US that they need to take care of. But whether they like to admit it or not, there is some demographic energy that springs up off of those immigrants coming into the country. They have to live, they have to spend, they have to produce. All of those things contribute ultimately to economic progress. He's got a fiscal problem on his hands. The US is already running a budget deficit of 6% and yet he wants to cut taxes. Well, how are you going to fund that? It's a major problem. And insofar as the stimulus question is concerned, he wants to stimulate, but the economy is doing just fine. It doesn't need stimulation. In fact, applying stimulation at this late stage of the game threatens to generate an overheated economy, which is also not what he wants. So with a lot of these things, there are mitigating factors that might dull the ultimate impact that Trump actually has when you look at the reality of what is versus, all the rhetoric that got him, those votes to begin with.
No, it's definitely not going to be able to come in and just go bang, bang and do as he pleases. And besides, the fiscal is not looking all that great, and the lending rates that's pretty high, or going to remain high at the high levels. The US is also stepping in when the US is involved in several proxy wars, whether it's Syria, whether it's Ukraine, whether it's Gaza. And of course, these global conflicts are also going to take center stage this year, and the trade disruptions that's caused. I mean, we saw China's trade data come out earlier this week, and it's all good and well. They recorded a 1 trillion surplus for the first time. But within the data, you really started seeing the effect of these trade disruptions come to life. You saw the traditional trade with the traditional Western partners falling off quite sharply, where there was a strong pickup with China's Asian partners, for example. So I think there's also going to be this trend of this friendshoring that's going to continue throughout 2025 as these wars continue to play out. But speaking of China, they, of course, have their own problems. We spoke extensively about it last year. Is the deflation spiral still a concern for you in China?
It is, Ilze-Marie, because they haven't yet reached the end of the correction for the real estate bubble bursting. Now, that real estate bubble has burst, well and truly. It is impacting bank balance sheets. We know that because house prices are falling at 7.5%. That was as of Q2. By Q3, we think that the situation is even worse. So you're talking about bank balance sheets that might be contracting, well, at least those assets on the bank balance sheets contracting by as much as 7 to 10% year on year. That's fairly significant. If that continues unabated for a while longer, what you'll end up happening is that those banks find themselves under pressure, and they find themselves under pressure to recapitalize. And if they're not recapitalized and they're forced to try and source that funding in the interbank markets, you tend to find that there's a liquidity squeeze that crops up. And if you think back to 2009 and 2010, when we had those banking problems in America through the financial crisis, you could see what that did to bank behavior, lending behavior. All of a sudden, the credit cycle turned lower and did so on a sustained basis, so much so that the central banks had to step in and reflate and inject liquidity and et cetera into the banking system. I'm not saying this is a repeat of 2009, but I am saying that the credit cycle in China is impaired. And it's impaired to the extent that I think it's going to detract from GDP growth quite significantly. And you're quite right. When you have a look at M2 money supply growth and you track that over inflation, you can see that there is a very real risk of deflation emerging. We know that there's deflation in the property market. Those asset prices are falling. So the deflation is certainly there in those assets. But there will be others linked to that will come equally under some pressure, and so those banks are under strain, and so naturally the credit cycle softens, and as that credit cycle softens, so you get deflation. But equally, you have a look at the IMF's forecasts on Chinese GDP growth, and they've sunk from levels closer to 5% to levels closer to 2.5%, which for China is a bit of a catastrophe because they need growth far stronger than that to absorb the amount of spare capacity and labor they have, and to generate the kind of demand that justifies all the construction projects and infrastructure projects that they're busy building. So China is in a very negative space at the moment, and as yet we haven't seen any clear indications that that's bottomed out and turned the corner.
And no, we shouldn't be mistaken. The Chinese state is very aware of this problem. They've embarked on massive stimulus packages to try and spur up consumption. There are some arguments that they're looking at this with a longer term recovery view as opposed to a short term view. Some of those projects and stimulus measures will take some time to kick in. But apart from the housing sector, this is just, a government really struggling again to get and recover from the pandemic. And they're not the only government that's still reeling. It's still not going as smooth as they want. And they've been going on these fiscal spending and trying to stimulate economies. But at some point, it's been 5 years. We're going in 5 years after the pandemic. The party has to stop somewhere.
Yeah, and I think you're raising another important theme that has me a little bit concerned, not just for this year, but for the next few years. And that's the fact that very few governments, if any, have been able to really get on top of their fiscal policies. A lot of them have racked up huge quantities of debt. So their interest on debt has risen very, very sharply. Interest rates the world over are higher, partly as a result of this poor fiscal policy stance that most governments around the world have. On top of it, they are all running significant budget deficits, which they need to rein in because their budget deficits are way above their GDP growth rates. In other words, they are adding to that debt pile relative to the size of the economy year after year after year, and that's never sustainable. And so ultimately, there needs to be some rationalization of those fiscal policies. We need to get back to positions of sustainability. But for that to happen, you need to make some really tough decisions. Either you're going to be raising taxes, as we're seeing in the UK, and you can see what the pushback, how strong the pushback has been against Rachel Reeves wanting to try and raise more tax revenue, or you've got to slash the size of government, which interestingly is one of the Trump policies. We've seen that undertaken in Argentina quite successfully, I must add. Yes, it's disrupted some services and whatnot, but at the very least, it has started to generate a more sustainable fiscal picture for Argentina. And they may be leading the way in terms of how fiscal policy is going to unfold through the course of time. But it requires a shift to more conservative policies. It requires a shift towards smaller governments. And that is going to be politically unpalatable for many governments around the world, including, ironically, South Africa's. So South Africa is going to be faced with a similar situation. We've got an enormous cabinet, far too big for a country our size. We have a tax base that is struggling to measure up to the tax revenues required to fund everything that needs to be funded. So South Africa's got some interesting, tough choices to make as well. And again, a lot of that is very much a function of the poor fiscal policies that have now become entrenched and embedded around the world, not just in South Africa, which will need to be addressed.
Speaking of South Africa, of course, we saw a change of the guard last year. The GNU seems to be holding together, even if it's just sometimes. But as far as trends for South Africa, one that I would like to see continue is the load shedding free one. So I can't remember the last time we entered a new year where there wasn't any real prospects of load shedding. So at least we're getting that right. But the one thing that I will be looking for is whether or not National Treasury and the government at large has done enough to get off the dreaded grey list. If I'm not mistaken, their deadline is February or March for some legislation. So there will be a big win if we can manage to just wipe South Africa's name off that list.
It would be a huge win if we could get that right. I think they've still got a little ways to go. They were talking, maybe getting an answer by middle of next year, or middle of this year, sorry. So I think from that side, we are hopeful that they have made strides. We know they've made strides, but there are still some difficulties that they need to overcome. Borders is one. The way the levels of compliance within certain sectors of the South African formal sector industries is another. So money laundering, for example, is still an issue that I know bothers them. And within the legal and real estate fraternity, those are still issues that need to be adequately tackled. And I'm not sure that we've gotten quite to the point that they will be comfortable, but we have made strides. South Africa has made a lot of headway. And some of the interactions and engagements I've had within the Reserve Bank roundtable discussions, it's very clear that there's been good progress made. Whether it's enough to get us off the grey list remains to be seen, but I think we've given ourselves a chance. If that does happen by the middle of this year, that will be a huge positive for South Africa. Not necessarily immediately that everything suddenly turns right, but at least we're on a firmer footing. We're not going to be a pariah state any longer insofar as these illegal, illicit flows internationally are concerned, and we stabilize the platform of which we can build again.
Well, hopefully we will get some more details in the budget in February, which, by the way, ETM Analytics, as per usual, will host a budget analysis to make sure you don't miss out on any of the details. So, George, thank you for joining me. I guess we will chat again then. But thanks for sharing your views on the predictably unpredictable 2025.
Thank you, Ilze-Marie.